Support for this podcast comes from Rich and Tang Deposit Solutions, providing sheet and cash management solutions to U.S. banks and other financial institutions since 1974. Thank you, Rich and Tang, for being our partner.
Good morning. My name is Andrea Vinci, and I am the Director of Communications at Bedford & Main Financial Consulting. I'm sitting here today with our President and CEO, John Foster, who founded the company in 2012 after an extensive career in senior management in the brokerage industry. Today, we're going to be talking a little bit about anti-money laundering with some information that is specific to the broker-dealer industry and many of our clients. So, John, welcome. Thank you for coming here today.
Good morning, Andrea, and thanks for coordinating this.
So, as I said, today we are going to be talking about anti-money laundering. And for me, as someone who works in a different industry, a financial outsider, I always thought of money laundering as something that was associated with criminal organizations or the mob, the mafia, etc. Can we start off with just giving our audience a basic common understanding of what anti-money laundering is and a definition and meaning of what it means to be an AML specialist in the field?
Sure, and you're absolutely correct. Money laundering historically has been associated with like hardcore criminal empires. I think a lot of people are familiar with the Netflix series Ozark, where he has to launder hundreds of millions of dollars. And there's this classic scene where he's filling the walls with money and paneling over the walls. And that really was the idea of money laundering for decades and decades. And that all changed in 9/11. 9/11 brought a realization that money laundering was also being used to finance terrorist activity. And now, most recently, we've seen changes where money laundering or anti-money laundering efforts are being put forth to really deter all kinds of financial fraud.
Yeah, so that's definitely kind of the association that I had in my head. So what we're going to do today is basically give a deeper, detailed information, would you say, about what it is and how it's relevant to the average person and to specialists in the broker-dealer field?
Yes, I want to concentrate on broker-dealers, and we're going to give it deeper in one sense, but also broad enough that I hope that the normal Joe listening this will be able to walk away with a good understanding of it. You know, sometimes this gets a little bit technical, and certainly it can get a little bit boring at times.
Okay, so I see that you are CAMS certified. Can you explain exactly what that means in its relationship to the AML field?
CAMS stands for Certified Anti-Money Laundering Specialist. It's a group that came about after 9/11 and stood up in the industry to develop kind of a gold standard for AML certifications. They do continuous training after you receive the certification also. So there are annual conferences, and each regional area has groups that sponsor conferences throughout the years so that people that are in the anti-money laundering industry can continuously be kept abreast of what's happening.
Okay, that makes sense. So for our viewers today, why don't we start by just framing the discussion with the concept of a bit of history about anti-money laundering. You touched on some basic points in our introduction, but let's delve into this. I know your expertise with anti-money laundering and broker-dealers, but let's get a broad perspective of why AML has changed from the old-time mod stuff to the stuff we're seeing with modern-day terrorism and securities fraud.
Okay, and that actually takes us back to about 1970 with the Bank Secrecy Act. So when the Bank Secrecy Act was passed, there wasn't a tremendous amount of attention. It was passed really with the idea of the old money laundering and preventing criminal activity. But as I said, it wasn't something that the normal person would say, oh, that's happening because of a regulation with Bank Secrecy Act. What changed was 9/11. In 9/11, they used the Bank Secrecy Act as the foundation, and the Patriot Act came in, a few months after 9/11 took place. The Patriot Act amended the Bank Secrecy Act, so very quickly the U.S. could pass regulations that monitored cash and negotiable instruments, which was based on money laundering initially for criminal activity, but now it was seen that terrorist financing used the exact identical means of laundering the money and coming up with clean money, so everybody was paying attention. At the same time, kind of globally, a few years afterwards, there was a group called the Financial Action Task Force, FATF, which passed the same type of anti-money laundering regulations. This came out of a G-Summit conference in Paris back in '89. So globally, the U.S. and other industrialized countries were all on the same page there.
Okay, so let me make sure I have the big picture and I can verbally summarize this history. The roots of anti-money laundering in the U.S. go back about 50 years to the Bank Secrecy Act. Similar regulations are in place globally in almost all developed countries. And it's kind of fair to say they all started off more to address criminal activity, but then the events of 9/11 added this new concentration on terrorism.
That's correct. I think that everybody has the basic understanding of money laundering being a process where you've got, say, dirty money, as it's referred to. It's come in from some bad source, like a criminal activity or a terrorist putting money in. They want to clean it by running it through different financial institutions so that at the end, there's a check or a wire coming out from what appears to be a very legitimate source, like a U.S. brokerage firm. So the difference with the Patriot Act was that it added in a new element for financial services firms under the U.S. Treasury Department. There's an arm under U.S. Treasury referred to as FinCEN. It's the Financial Crimes Enforcement Network. And it was put together. Their job is collect all this information, get all this data coming in from broker-dealers, banks, credit unions, any kind of financial institution that's dealing with customers, and analyze that and see, are there patterns? Can they come up with leads towards money laundering, financial crimes, terrorism, and such things? So there were two major impacts of FinCEN. One is it created new reports that all these financial institutions had to do. Currency reports, monetary reports. $10,000 was used as a threshold, relatively low threshold. And then two, the participants had to file what are referred to as suspicious activity reports. So now there's a requirement to monitor this activity and to file a report if you see something that looks out of the ordinary with it. The Bank Secrecy Act didn't demand the industry to take those kinds of steps, and now post 9/11, FinCEN's in place. Everybody has to gather this information and send it in. I know that's kind of a lot to say, but I hope that answered the question.
No, I actually think that really helped to summarize it and explain it a little bit further. So before we move on to our discussion of regulators, let's take a break and hear from our sponsor.
Today's podcast is sponsored by Rich & Tang, who provides a complete suite of deposit solutions to their clients around the country. Their FDIC-insured cash sweep programs offer competitive rates and cash security through a network of U.S. banks for customers of banks, broker-dealers, trust companies, and wealth advisors. Rich & Tang streamlines technology with an unyielding focus on client partnerships to develop flexible solutions to meet the deposit, liquidity, or the short-term investment needs of any organization.
All right, everyone, welcome back from our commercial break from our sponsor. So I have a question. Is that unusual for brokerage firms to follow rules for the U.S. Treasury? Aren't they the group, or at least one of the agencies, that normally regulate a brokerage firm?
Surprisingly, it is a bit unusual. Brokerage firms fall under the regulatory umbrella of the Securities and Exchange Commission. It's the SEC that ultimately governs and dictates everything that's done within a brokerage firm. However, the SEC then allows FINRA as a regulatory entity to run the day-to-day, if you will.
And what exactly is FINRA?
FINRA is an acronym for the Financial Industry Regulatory Authority. So the group it's a self-regulatory organization, actually. It assists the SEC in regulating financial markets. So FINRA was initially formed, I guess it's been more than a decade at this point. It was a combination of the two main regulatory entities, the NYSE for the larger broker-dealers that were members of the NYSE, and the NASD for the smaller broker-dealers. It has jurisdiction over all broker-dealers and all registered reps, so all financial advisors fall under this also. And it has the authority to discipline firms and individuals who violate the rules. So as a self-regulatory organization, in fact, I believe it's the largest self-regulatory organization in the U.S., it not only writes and enforces some of its own rules and regs governing the industry, but it is tasked with enforcing the federal laws that come down from the SEC.
Okay, then. So FINRA is the main regulator for AML issues that broker-dealers might have. And you said FINRA enforces the SEC rules. Would they then also enforce Treasury requirements as well?
Good question. And the answer is yes, they do. And what was unique about the Patriot Act is it added U.S. Treasury obligations to broker-dealers and other financial institutions. So it was a different element, a different regulatory obligation that was developed out of the Patriot Act.
So, John, would you say that the FINRA rule is the most important or the most extensive?
Well, FINRA as a regulatory entity is the day-to-day, as I said. They passed a rule, not to throw out numbers, but it's Rule 3310, referred to as the Anti-Money Laundering Compliance Program Rule, which dictated how broker-dealers had to enforce this. And it's actually relatively simple. Today there are 5 main parts. One just says, hey, a broker-dealer has to develop a written policy, written program designed to meet the Bank Secrecy Act. And it goes into a couple subsections on that, saying it has to be reasonable and what's expected. Secondly, it puts the responsibility on a person. The broker-dealer has to designate and identify this person is responsible. Here's their name, here's their address, here's their title, there's their phone number. Third, you have to have ongoing training, and that's on an annual basis, and you have to be able to prove these people have been trained for what is applicable to their position related to anti-money laundering. Fourth, and this has changed a little bit recently, is risk-based procedures for conducting due diligence of clients. So the days are gone when you could go in and kind of fake being somebody else or use a bad ID or this or that or say, hey, I don't want to give this information. You've got to identify if you're going to be moving money in the U.S., if you're transacting business. And most people see that just with opening up normal bank savings accounts. There's a lot of information that's got to be provided. And then lastly, of course, is there has to be an annual independent test that's done each year.
And this independent testing, are these services that you provide as part of Bedford and Maine?
It is, and that's what's gotten me involved. I've gotten involved with the independent testing, and I've gotten involved on the expert witness side. I like doing the independent testing because it keeps me very, very in touch with everything that's happening in the business so that when I do expert witness work, it's applicable.
So as far as government rules and regulations go, that honestly sounds fairly manageable.
I agree, and it is. It's funny because FINRA offers a template to write these supervisory procedures, and despite the 5 relatively short rules, the template's 54 pages. But yeah, I agree with you. It really isn't that bad.
Is it fair to assume that knowing these SEC and FINRA rules is what your expert witness services are based on?
Well, sure. One must have a deep understanding of the SEC, the FINRA, the U.S. Treasury rules. That would be the most basic component of being able to provide expert witness services in this area. My guess would be that most folks who are providing these services, like myself, are also CAM certified, as that is the one entity which does any type of training and certifications here. But I'd have to say, on top of that it's really the hands-on work that I do, working with the broker-dealers to build their AML program, sometimes from scratch, assisting them to write the written supervisory procedures and customizing these for their individual firms, and, of course, performing the annual on-site tests and verifications of their programs. That is what's really given me what I consider to be my foundation for providing expert services and litigation support.
Going back then to the point that this requires an independent test, can you elaborate a little on what types of tests you've personally been involved with?
It's been really interesting to me because there's such a variety, and I think this comes back to the fact that you've got to customize and tailor for each firm. So I've had the privilege, if you will, of testing firms that were very, very large, over 1,000 financial advisors, to literally one-man firms that sold private placements. I've worked with firms that had very simplistic products, pretty vanilla, chocolate, strawberry. I offer U.S. equities, mutual funds, options, to firms that have really sophisticated products where they're offering foreign correspondent accounts and numbered accounts and lots of international wires being processed for political figures, and that gets pretty touchy. You've got to really know what you're doing and have some tight controls. There are broker-dealers that really just service non-U.S. clients and some just service U.S. clients.
Does that create a problem for you?
Frankly, from my perspective, having the opportunity to be exposed to so many different money laundering issues is a real plus.
So is there a common thread then in your approach when you perform the test?
Well, only in that it's customized, it's tailored. My common thread is that I look to each individual one and try to prepare a test that is going to really look at the risk profile of each firm, which I think is exactly what FINRA is looking to have done.
In your own words, how exactly would you sum up the test process?
Well, I try to add a lot of value to it. The test, it's interesting because it really says there has to be an annual test. It doesn't really say much more than that, to be honest with you. So it's not saying what has to be tested or the extent or depth of anything. So, I try to develop a different type of test to make sure these are solid programs, and I try to offer people some good insights. I never do a gotcha type approach. My intent is simply to provide some in-depth feedback to my clients, so it's a value added.
So we're sitting here today in New Jersey taping this. I know Bedford and Maine is located in New Jersey. Will you actually go and visit the client to perform the sample testing?
Yes, absolutely. In fact, I won't do the 3310 review unless I do an on-site visit. I just feel that it's just not giving it what it needs to have in terms of attention and seriousness if you're not knocking on a door and sitting with the AML officer or the compliance officer. So I will only perform an on-site review.
I would assume then that your expert witness services are also not limited to a geographic area?
That's correct. Providing expert witness or any type of litigation support on a whole is really never limited to the Jersey, Philly, New York area. While I do see that the number of cases that require anti-money laundering broker-dealer expertise seems to be growing, as with pretty much any expert work, short of meeting with the lawyers involved, or if it does go to trial or arbitration, there's typically minimal travel.
Okay, so John, you mentioned a bit back about the U.S. Treasury Suspicious Activity Reports, the SARs, and I kind of get the feeling that they're a pretty important part of this process. Can you tell us a little bit about that?
Certainly. So yeah, and you're correct. SARS reports are unique and different, and it's really there's a two-part process or a two-part obligation. The AML program has to be risk-based. So to be risk-based, you got to look at your clients and say, I understand what their activity should be, and I monitor, detect, if you will, when there's something that changes from what the normal activity is, and that has to be reported on a suspicious activity report.
Can you give a concrete example of exactly what that might be?
Well, okay, let's give like a real simple example. You're a U.S. account. You're Andrea and Benjamin Vinci as a joint account, and you're buying and selling U.S. equities and mutual funds, and all of a sudden you start sending wires abroad to international financial institutions. That would step out of your risk profile, and the broker-dealer should be saying, wait a minute, what's happening here? Why are they looking to do that?
You're saying that a firm sees something funny, they file the SARS report with the FinCEN group, they don't get any kind of feedback or guidance as to whether they should or should not have filed the SARS on the given incident, To me, that just seems odd. So explain to me from your experience, do you have a feel for how often these secret reports are actually filed and who uses them, if anyone?
That's a good question, too. And yeah, they are kind of secret reports. I mean, you're not, as a broker-dealer, you're not allowed to tell the client that you have filed a SARS. You can't tell their advisor you filed a SARS. This information isn't even shared with all of the senior management. I've worked expert witness issues and have learned that these reports cannot even be subpoenaed by a court for a civil matter here. So to answer your first question or your first comment, are they secret? Yes, very, very highly confidential. In terms of your second question of, do we have any experience as to how often? I read a report once a few years ago that said on an average, a broker-dealer files about 5 a year, but a large number of them file none or maybe one. And I share this with my clients. And my larger clients, yes, do about 5 a year. Some do much more than that. But I also have a number of smaller clients, particularly classic U.S. retail with mom-and-pop type accounts doing a vanilla chocolate products, and rarely do they end up filing one.
Okay, then explain to me why a firm wouldn't just file away if the SEC is pushing it.
Well, I think there's a cultural type thing, and this is kind of what I've picked up, and this is, again, my own personal experience. I deal with firms, and they feel like, geez, if we're putting a SARS in, we're admitting something's wrong with one of our clients, or we're kind of falsely accusing, and we're not really sure, or maybe it reflects poor on the advisor. I think that's part of it. I think a second factor could be the fact that there is no feedback, that folks feel I do a heck of a lot of work and nobody looks at these. It goes into the governmental black hole, if you will. It's interesting. I have some experience with that from one of those CAMS conferences I was mentioning to you earlier. I sat in on a conference this past year of a panel that was discussing SARS, and these were government agencies. This panel consisted of TSA, FBI, DEA, and DOD. Pretty serious panel here. And they shared some amazing stories with us as AML professionals as to how meaningful these SARS transactions can be. Things that we would never dream, yet us reporting this odd transaction ended up being the tip of an iceberg, and they were able to do some really meaningful, significant things with it.
Yeah, when you're talking about the FBI, Department of Defense, TSA, DEA, that paints a pretty clear picture for those of us who are not financial industry folks that anti-money laundering is a bit more of a serious issue than I think we would have realized. So this is one of your continuing education courses that you mentioned earlier, part of being CAMS certified and AML specialist. Are there changes to the laws that you mentioned that broker-dealers are going to have to keep up with on a regular basis?
Well, there haven't been, in my opinion, as much from the broker-dealer community, but then after many years, yes, recently there've been a couple. Last year, FinCEN put out its first new regulation since the Patriot Act. So that would have been, Patriot Act is passed in 2002. In 2018, FinCEN's putting out a new regulation, and this was about customer identification, and this was more due diligence on legal entities. So it passed a rule that a lot of people felt should have been in place a long time ago, where you have to identify for a legal entity. There's a lot of exceptions if you're listed on an exchange or such, but if you're not, and you're a corporation and you're trying to hide who owns it, this rule makes you identify a control person and anybody that has at least 25% ownership in it. And that's a pretty big deal.
So what's the second change?
Second change was on red flags. So, the term red flags is commonly understood. But in terms of anti-money laundering, the predecessor to FinCEN, I had mentioned one of them was the NASD. The NASD put a notice out right after the Patriot Act in April of 2002, and it listed the first list of red flags. And these were pretty obvious things. If a client doesn't seem to care about how much commissions, or they're sending wires that don't make sense, and, there's that type of activity. And that list of red flags had not changed again since April of 2002 until literally this year. A couple of months ago, FINRA revised that list. They added about a third more and kind of did a complete revamp and categorized them. So two big changes in the past year after truly kind of some stagnation for quite some time.
Yeah, so after almost 20 years past the Patriot Act, brokerage firms are still making mistakes and paying significant fines.
Well, you're right about that. You can go back historically and you can see that, there's just fines after fines that are paid by big firms, but it's not just big firms. So this year, on the big side, BNP Paribas, $15 million. On the small side, I know a firm that has less than $2 million in revenues, and they got hit for $75,000, which statistically is pretty big amount for a small firm. And because of that, FINRA continues to do the training. In 2019, they had 4 unique training sessions in key markets that they held across the U.S. Last year, I looked at the top 8 FINRA fines and violations. Of the top 8 largest fines, 4 of them were anti-money laundering. So, yeah, there haven't been a lot of changes. They continue the education on it, yet firms continue to make mistakes with it.
All right, so let's take a break again. We're going to hear from our sponsor one more time before we talk a little bit about today's environment in AML.
Thanks to Rich and Tang Deposit Solutions for being our partner. With billions of dollars in total deposits sourced for their clients, Rich and Tang is one of the most relied upon partners for deposit funding solutions.
All right, we're back here. So, John, can you just kind of sum up for us on a broad level what today's environment is in AML?
Sure, and I think the concentration really is with transaction monitoring. We've talked about customization and tailoring and the risk profiles for the broker-dealers. The evolution, as we started to say in the beginning, went from criminal activity to terrorist activity, and now the SEC is really pushing that a strong transaction monitoring program is also going to be like the cornerstone of your compliance to catch any type of financial fraud. So if there's insider trading or some kind of manipulating scheme, certainly Ponzi schemes. In fact, I was fortunate. I served as an expert witness in a civil case that had exactly these elements built into it. A good transaction monitoring system is going to catch these type of things. I actually think it's been pretty interesting that in the last few years, you've seen the AML rules used more for some of the institutional side of the brokerage industry than versus traditional retail. So the SEC and FINRA have repeatedly said, hey, a strong AML program affects some other key initiatives that they've been pushing to in terms of enforcing rules. One is direct market access, and direct market access is nothing other than when one broker-dealer makes it available for another entity to go straight into an exchange and to execute trades. Well, you got to be awfully careful who's that other entity, and are they doing it for themselves or for somebody else? So you can't make available a means to transact securities, to move money effectively, if you're not following down the train and doing that same kind of customer identification. And then the second means is master feeder account. Same type of thing where you have a feeder account that's feeding transactions into a master account. You've got to be sure to check that feeder account and know who that client is.
So to some extent, I can see where it makes sense to use existing processes, technology, and try to expand anti-money laundering to help control financial fraud. But on the other hand, if a firm has a set business, like the chocolate, vanilla, strawberry types that you were mentioning before, is it really fair to expect the firm to be responsible for more and more things when their business hasn't really changed?
Is it fair? A lot of people would say no. Is it the fact they are? Yeah, it is. Plain and simple. These smaller firms have to spend the money, have to get their programs up to par. It's just expected of them. We saw a fine in 2005 that the SEC specifically said they were fining the firm because they didn't put enough resource into compliance. They didn't have enough people monitoring it. They hadn't put enough money into monitoring these systems. We saw that same exact fine with BNP this past year. So it's over 10 years, and they've been very consistent to point out, yes, the world is changing. Yes, there's more expected of you. That's just the nature of the beast. And the firms are expected to put in the resources that are demanded.
All right. So I think today we got a lot of good basic information about what anti-money laundering is, the history of it, where the industry is at today, regulations, requirements, testing procedures. So I just want to thank you, John, for being here with us today.
Thank you, Andrew. I really enjoyed this today.
And I want to encourage our listeners to go ahead and get some more information about our AML services at www.bedfordandmaine.com. Again, we provide the independent testing services, and we also have expert witness services in the area for SEC trials and regulations.